Hello friends. Friends, we are going to continue with ratio analysis. So far in the ratio analysis we have covered two types of ratios. The one is liquidity ratio, right? Under liquidity ratio we covered two ratios. One was current ratio and the second one was quick ratio, right? So liquidity ratios talk about the short term analysis. The second we studied about solvency ratios, right? In the solvency ratios we studied four ratios, that is debt equity ratio, second one total assets to debt ratio, third one proprietary ratio, then interest coverage ratio, right? And the solvency ratios talk about the long term analysis about the financial position of the business. Clear? So we have covered these two type of ratios, liquidity ratios and the solvency ratios. Now in this lecture what we are going to start with is, we are going to start with another type of ratios, that is activity or turnover ratios. Activity or turnover ratios, right? Now, first of all, we'll try to understand what is the relevance of these activity or the turnover ratios. Why are these ratios helpful for the business? Now, these activities tell us about the efficiency of the business. Tell us about the efficiency of the business. Now the question is, efficiency about what? The first thing I am telling regarding the activity or the turnover ratios is that these ratios help in identifying the efficiency of the business. Now the question arises, efficiency related to what? Right? Efficiency related to the various resources of the business. Various resources of the business. Resources like labor, material, right? So activity or the turnover ratios tell us about the efficiency of the business. Efficiency related to the efficient utilization of the resources of the business, right? So write this down. Activity ratios tell us whether the various resources of the business are being efficiently utilized or not, right? So this is the main purpose of using the activity or the turnover ratios, to identify whether we are using our resources efficiently or not. Clear? Now, if we talk about the activity ratios, we have four types of ratios under the activity ratios, right? Under the activity ratio itself, we have four types of ratios. The first one is inventory turnover ratio. Right? The second one is trade receivables turnover ratio. Third one is trade payables turnover ratio. And the last one is working capital turnover ratio. Right? So under the activity or the turnover ratios, which tell us about the efficiency of the business, which tell us about the efficient utilization of the various resources of the business, we have four ratios. The first one is inventory turnover ratio, the second one is trade receivables turnover ratio, third one is trade payable turnover ratio, and the fourth and the last one is working capital turnover ratios. So these are the four ratios that we are going to discuss in detail under the activity or the turnover ratios. Clear? So let us start with the first one, that is inventory turnover ratio. Let's start with this one. Let's start with the first one, that is inventory turnover ratios. Inventory turnover ratio. Now, we have been continuously studying that ratio is a relationship between the two financial factors of the business. Here again, we have to establish a relationship between two things. Right? Under the inventory turnover ratio, we have to again establish the relationship. What is the relationship that we have to establish? We have to understand that. Right? Now, let us take a very simple example. There is Mr. A, right? He is a trader of t-shirts. He is a trader of t-shirts. Right? Mr. A buys t-shirt from X. Now, Mr. A buys 5,000 t-shirts from X at the rate of rupees, say 1,000 per t-shirt. Right? Mr. A is a trader of t-shirts, that is, he is buying the ready-made t-shirts from X and he is selling to the various customers. So Mr. A buys the t-shirts. Mr. A buys the t-shirts, 5,000 t-shirts from X at the rate of 1,000 per t-shirt. Clear? Now, what is the cost of buying t-shirts for Mr. A? What is the cost? 5,000 t-shirts multiplied by 1,000 per t-shirt. This comes to 50 lakhs. Now, Mr. A will obviously sell these t-shirts at some margin. That is, he will sell at a rate higher than 1,000 rupees. Isn't it? He has to earn some profit. He is paying 1,000 rupees to buy those t-shirts, and So he will sell them at least 1200, 1300 or 1500 per t-shirt to gain some profit, isn't it? So I'll say Mr. A sells these t-shirts at the rate of rupees 1500, right? So Mr. A sell these t-shirts at a rate of rupees 1500. Now what we have to identify through inventory turnover ratio, what we have to identify, right? Here it is what? 500 is the profit of Mr. A. Profit of Mr. A. Now the first and the foremost thing that we have to identify in the inventory turnover ratio is that in a year or for a period under consideration, how many times Mr. A is able to sell these t-shirts. What it means? These t-shirts are the inventory of Mr. A, isn't it? Mr. A is a trader. He is buying the t-shirts from X. Right? We'll call these t-shirts the inventory of Mr. A. Right? So first thing we have to identify, the first relevant thing under the inventory turnover ratio is how many times Mr. A is able to convert its inventory into sales. Right? In other words, I will say how many times Mr. A is able to convert his inventory into sales. Right? How many times Mr. A is able to convert his inventory into sales? Now, what will happen when we are converting the inventory into sales? What is the first and the foremost thing that is happening is we are able to recover the cost of buying the t-shirts. Now, I say Mr. A sold all the 5,000 t-shirts at the rate of rupees 1500. Mr. A in a year bought 5,000 t-shirts from X. He sold all the 5,000 t-shirts in a year at the rate of 1500. Now what happened? In this part there are two elements. The first is the cost part at the rate of 1000. The second is the profit part. Now if the Mr. X is able to sell all the t-shirts, that means he has recovered his cost by selling the t-shirts. He has recovered all the cost of buying the t-shirts by converting his inventory into sales, and he has earned a profit, isn't it? Obviously, this is what we are going to say, that Mr. A bought t-shirts from Mr. X. Now these t-shirts are the inventory for Mr. A. Now we have to identify how many times in a year Mr. A is able to convert his inventory into sales. That is, how many times Mr. A is able to sell these t-shirts in a year. Right? As many t-shirts Mr. A will sell, that much cost will be recovered. Right? So what is the main aim of the business? What is the main aim of Mr. A? Main aim of Mr. A is to convert its inventory into sales. Right? Why? Because he wants to recover the cost of 50 lakhs that he has spent on buying the t-shirts. Plus he wants to earn some profit. Right? Mr. A's aim is to convert its inventory into sales so that he is able to recover the cost. So that he is able to recover the cost of buying the t-shirts, and at the same time he is able to earn some profit. Right? So this is the main motive of calculating inventory turnover ratio. That is, how many times in a year you are able to turn your inventory into sales. How many times in a year you are able to convert your inventory into sales, and through those sales, through the revenue that you have earned, you are able to recover your cost. Right? You can write this down about inventory turnover ratio. Inventory turnover ratio tells us about how many times we are able to turn our inventory into sales, and consequently able to recover the cost of goods those are sold. That is cost of inventory. Right? Mr. A will try to sell all his inventory so that he is able to recover the cost of 50 lakhs that he has spent on buying the t-shirts. Are you getting my point, guys? Right? This is the main motive of inventory turnover ratio. We have to see how many times we are able to sell our product and recover the cost that we have incurred on making or buying the product. Listen to it very carefully. Again, I am repeating. The main aim of inventory turnover ratio is to identify how many times in a year you are able to sell your product and recover the cost that has been incurred in buying or manufacturing that product. Clear? So now, what are the two factors that we consider in inventory turnover ratio? I have been focusing on those two factors. If you have listened to it carefully, you will be able to get those two factors. Inventory turnover ratio. The first factor is the cost of goods sold. That is, by selling the goods, how much cost we have recovered, divided by average inventory held during the year. If this average inventory is low, that means you have recovered more of cost. That means you have sold your product and recovered your cost. If cost of goods sold is less, average inventory will be high. That means you haven't sold your product, you haven't been able to sold your product, and your cost of goods sold is low. So higher the ratio, better it is. Because if you are selling the product, only then your cost recovered of the goods sold will be high and your average inventory held during the year will be low. Right? So higher the ratio, better it is. Right? How better it is? That means you have converted your inventory into sales, you have recovered your cost, so cost of goods sold will go up and your average inventory held during the year will go down. Clear? So friends, average inventory turnover ratio tell us about that in a year how many times we are able to convert our inventory into sales and consequently recover the cost of buying or manufacturing the product. So the two financial factors that are involved here are cost of goods sold or the average inventory held during the year. Clear? Now, how to calculate? Now you have two elements. The first is cost of goods sold. Now you have to identify how to calculate this. Cost of goods sold. First of all, you will take the total revenue from the operations. 5,000 t-shirts into 1,500. This is what you sold. This is what you sold. Right? How much? 75 lakhs. Right? Now, from this 1,500 contains two elements. It contains 500 as the profit. So if I reduce this profit 500, how much? 25 lakhs. I will get the cost of goods sold. 50 lakhs, see here. He bought the goods from Mr. X for 50 lakhs. So if I reduce from the total revenue from operations, total revenue from selling 5,000 t-shirts, he is getting 1,500 per t-shirt. That is, he is getting 75 lakhs. From that, if I remove the profit element, what will happen? I will reach at the cost. Right? So its formula is, if you talk in the formula terms, it is revenue from operations. Revenue from operations means revenue from selling 5,000 t-shirts at the rate of rupees 1,500 minus gross profit. Profit is 500 rupees in those t-shirts. Are you getting my point? So how to calculate cost of goods sold? The one way of calculating it is revenue from the operations minus the gross profit element in that revenue. If we remove the profit part, what do you get? You get the cost of goods sold. Right? Cost of goods sold. Now the other part of calculating it is, if you remember the trading account, you have prepared the trading accounts, right? So I'll write the second part here. Okay, I'll move the sheet. So if you talk about the second part, you have prepared trading account, isn't it? You have prepared trading and profit and loss account. What do you take here? Opening stock, right? You take opening stock, you take purchases, you take direct expenses, then you take sales, then you take closing stock. Forget the profit element. What you get? Profit. Okay, I don't take this profit element. Right? What I will say is opening stock plus purchases plus direct expenses minus the closing stock, I will get my sales. And I'm not considering the profit part. What I will get? I will get the cost of the goods sold. Right? Here the sales have two elements. One is the cost plus the profit. Okay, I leave the profit. I am not considering this. I am saying the profit is 0. Right? So what is the sales? What is the sales is the cost of the goods sold. So the other formula for it is opening stock plus purchases plus direct expenses if any given minus closing stock. So what you will get? You will get the cost of goods sold. Right? I've explained you from the trading account, opening stock plus purchases plus direct expenses minus closing stock, you will reach at the sales. And if I remove the profit element from the sales, what do you get? Cost of goods sold. Clear? So friends, this is the case when you can calculate cost of goods sold in case you are a trader. Like Mr. A, you are buying the ready-made goods from Mr. X and you are directly selling the goods to the various customers. Right? You are what? You are a trader. You are not a manufacturer. You are not making any product. You are just buying the product, selling the product. Buying the product, selling the product. You are not manufacturing anything. You are not making a product and selling it. You are just buying and selling. Right? Are you getting my point? Now, if you are a manufacturer, then what you will do? In case you are a manufacturer of a good, then how will you calculate? Then how will you calculate cost of goods sold? How will you calculate this? Very simple. More or less it will remain this: opening stock plus purchases plus direct expenses minus closing stock. The only one thing that will include extra is the cost of materials consumed. Right? What you will say? Cost of material consumed. Right? Suppose you are a t-shirt manufacturer. Right? A lot of material is consumed in making a t-shirt. Right? Cloth is required. Then the buttons are required. Collars are required. Cuffs are required. So various materials are used in the manufacturing of a t-shirt. So you have to identify the cost of the material that has been consumed. Right? Plus purchases. Right? It says plus the change in inventory. Change in inventory. Right? Change in inventory. It divide inventory into three parts here. FG, that is finished goods. WIP, that is work in progress. Right? And stock in trade. That is, we have ordered the stock and it is in process. Right? Change in inventory means opening stock minus closing stock. Very simple. Change in inventory. What do you have? The opening stock. What is your closing stock? The net effect is the change in inventory. Right? Plus any direct expenses if given. So if you are a manufacturer, you will calculate the cost of the goods sold in this way. You will find out the cost of material consumed. More or less it will be given in the question. At your level it will be given. Right? If I talk about the higher levels, at the CA levels, sometimes you have to calculate the cost of material consumed. At your level, more or less it will be given. Right? Plus the purchases plus if there is any change in the inventory. Change in inventory means simply the opening stock minus the closing stock. What is the change during the year? My opening stock was 1000 rupees, my closing stock is 5000 rupees. That means 5000 t-shirts. That means during the year I have bought t-shirts 4000, right? Plus any direct expenses if any. More or less you can understand this from the trading account only. Opening stock plus purchases plus expenses plus material consumed minus closing stock. What you will get is the cost of goods sold in case you are a manufacturer, right? So in this way we have covered one part. We have covered one part of inventory turnover ratio, that is cost of goods sold. Right? The first way is for the trader, total revenue from the operations minus the gross profit. Right? Then we have the second part. Second part says the opening stock plus the purchases plus the direct expenses minus closing stock. And then if you are a manufacturer, you have to add the cost of materials that have been consumed in manufacturing a product. Right? Then the second element of the inventory turnover ratio is average inventory held during the year. Average inventory of what? Average inventory of finished goods that you are selling. Finished goods to be sold. Right? Very simple. What is the opening stock of FG that you have plus the closing stock of inventory that you have divided by 2. This is the average inventory that you hold during the year. Clear? So now you can build the relationship between inventory turnover ratio, that is the cost of goods sold, divided by average inventory. This means how many times you have been able to convert your inventory into sales, and consequently you have been able to recover your cost on the goods sold. Higher the ratio means that you are being able to convert more of your inventory into sales and you have been able to recover more of your cost incurred during that year. Clear? So friends, this is about the inventory turnover ratios. Be careful about the cost of goods sold calculation. That is the only technical point here. But if you have understood the logic that why we calculate the inventory turnover ratio, then it won't be difficult. What you should know the purpose why we are calculating that ratio. Right? Mr. A is interested in recovering its cost of 50 lakhs that he has spent on buying from Mr. X. Obviously, he has to recover as soon as possible. Right? So this ratio is helpful at that point, that whether we are being efficiently able to convert our inventory into sales, right, and recover the cost of that product. Clear? So friends, this is about the inventory turnover ratio. Now in the next lecture, we're going to do the practical problems. We'll do practical problems on inventory turnover ratio. Right? So if you have any problem, friends, you can mail me at ksjteaching@gmail.com, right? So in the next lecture, we'll continue with the inventory turnover ratio and we'll do some practical problems on it, right? So that's all for this lecture, friends. Thank you so much.